Hello and welcome to this recorded video on tackling a constructed response question on the financial management exam of ACCA, and my name is Waleed. So a bit more about me. So I am the head of exam prep at Kaplan Professional Middle East, and I also teach financial management and management accounting exams. I put my contact details there, so just in case you have any questions post this video, you can always feel free to send an email to me at that email address. Now, without wasting any time, let's go straight to ACCA's testing platform, TestReach, where I'm going to show you how to tackle a constructed response question, a section C question in the FM exam. And I've taken the specimen exam here, which is available on the TestReach, and this question is VIP core. So I'm planning to do part 1 and 2 of this question, where I can show you some spreadsheet tricks to deal with this requirement. So let's have a look at the scenario first. So the scenario says that VIP Co, a large stock exchange listed company, is evaluating an investment proposal to manufacture W33, which has performed well in test marketing trials conducted recently by the company's R&D. It will be manufactured using a fully automated process, which would significantly increase the noise levels from VIP company's factory. The following information relating to this investment proposal has now been prepared. So we have the initial investment, which is $2 million. So this initial investment is obviously the capex, which would be deducted at T0. We have the selling price, but that selling price is in current price terms, which means that we may need to inflate the selling price, and this is per unit. We have the selling price inflation of 3% per year, so we will inflate it for the number of years. Then the next thing is the variable costs, which are also in current price terms, and they are $8, which means we'll need to inflate them as well. So we will be inflating them at an inflation rate, which should be given to us, and it's here expected operating cost inflation rate, which is 4% per year. And then we are also given information about fixed operating cost in current price terms, which is $170,000. $170,000. Now, this is all the data. We have all the data for the operating cash flows of the profits. Then it says the R&D has prepared the following demand forecast as a result of marketing trials. The forecast reflects expected technological change and its effect on anticipated life cycle of W33. So it's a 4-year project, and the demand is given. It is expected that all units of W33 produced will be sold in line with the company's policy of keeping no inventory. No terminal value or machinery scrap value is expected at the end of 4 years. So there's nothing on the scrap value. There's no scrap value at the end of the 4 years when the production of W3 is planned to end. For investment appraisal purposes, VIP uses a nominal discount rate of 10% and a target return on capital employed of 30% per year, and ignore tax. Okay, so we have the discount rate available. We will do all our cash flows and then discount it at the 10%. So the first thing is the NPV. So you can always change the size of or the screen split for you in the exam. And now I will go and start solving this. So my first part that I'm going to do here is the NPV. Now for the NPV, I would first do the workings, which are really important. So in my workings, my first working is going to be working 1, and that will be the sales working. So working 1, sales working. Now in the sales working, I know it's a 4-year project, 1, 2, 3, 4, and I have the selling price per unit, which I need to inflate. So my selling price per unit given is $20, and I will inflate it at 3%. So $20, inflating it by 3%. And because the selling price is not changing, then I can take the previous year's figure and then inflate it by a further 3%. So we can take the previous year and do the 3% on that. And that will be my selling price now computed, which is inflated. And obviously you can drag forward the cells as well to fill up the values in the remaining cells. We have the demand or the volume, which is here, and the volume is 60,000. We have 70,000. We have 120,000, and we have 45,000. So once I multiply my sales price with this volume, I should then have my total sales, which comes out to be this value. So now I can drag this forward, and that should fill up all the values. So that is my sales value computed. That is my sales value computed. And we are going to just present it better. So this will put a separator and remove the decimals. So here are your 4 years worth of values of the sales now computed. In the same way, what I can do is I can do variable cost working as well. So if you see the variable cost, it is $8 per unit, and it will inflate by 4%. $8 inflate by 4%. Now what you can do is you can just copy this and then change things on that second working, which would save a bit of a time. So this is working 2, and the working 2 is your variable cost. So let's have a look at that. So I'm going to put my variable cost per unit. And the variable cost now is going to be your $8, and you will increase it by 4%. And then you take the previous value and you just change that to 4%, and that's it. So that should give you your variable cost computed, which is inflated at 4%. And I will change this to total variable cost now, and I've got my variable cost. So that didn't take long once I copied, and I was smart in dealing with it. The next one is the fixed operating costs, and the fixed operating costs are 170,000 per year, and that's in current price terms as well. So what I will do then is I'll say working 3, my fixed costs. So that's 1, 2, 3, and 4. So total fixed costs, I'm going to use that here. So that is 170,000 into 1.04. And because it's not changing, then we can take the previous one and increase it by 4%. So 4% increase on your previous values. So here you see I put here the drag function, and therefore I have increased it by 4% on the previous values. So that is your fixed cost. So I will just improve my presentation on this, and I'm going to put a separator and remove the decimals, and that's it. All your costs are now complete, and it's just a matter of putting them into the format now. So if we can go to the NPV format, and on the NPV format, we'll put here as T0, T1, T2, T3, and then T4. And the first thing which I'm going to put here is my sales values, my variable costs and fixed costs. Now, the easiest way to do this is you can just find your operating cash flows. And how you can find your operating cash flows, you can take the sales of year 1, which are here. And from these sales, you can deduct the variable cost of year 1, which is here. And from this, you can deduct the fixed cost of year 1, which is here. And that fills up your operating profits or cash flows for year 1. And if I just drag this forward, it will fill up all the remaining things. So that saves a lot of time for us in the exam. That is, we do not need to worry about doing all those things again. So that is your operating cash flows on this question. Now, once you've got these operating cash flows, the next thing what you can do is you can think of your investment, and the investment value which was given here to us was 2 million. So that's the 2 million negative. 1, 2, 3, 4, 5, 6. That's 2 million. And then I can do my free cash flows because there was nothing else here. And these free cash flows would just be this and this total. And I can drag this forward just so that I have one line available for my free cash flows. And now it's the time to discount this. There's no tax, there is no working capital, there is no scrap value. So I just need to discount this at the 10%. Now, how do we discount this at 10%? We use the NPV function. And the NPV function is NPV 10%. And I'll take the range of all the cash flows that I want to discount, which are these ones from year 1 to 4. And I will close the bracket and add my investment separately. And that gives me the NPV for this project. And the NPV for this project, again, I will repeat the function. The function is you take the NPV and you say 10%, you specify the range of cash flows from year 1 to 4, and then you add the investment separately, which obviously does not need to be discounted. And the final answer which I get here for this NPV is 367,785. So that is our NPV computed. And that was nice and quick with the functions and being a bit smart about this. The second part is IRR. So when I look at the IRR, we just need to use the IRR function here. That is equal to IRR. Take all the free cash flows, and that should give you an IRR. So IRR function is equal to IRR. Take all the cash flows, and that is your IRR function. And we can show that as a percentage. And that is 17.99 or 18% as your IRR on this question. So these are the first two things. And of course, that was really quick and nice and easy for us to get these values. Now, the other thing I would like to cover here before I close this video is the next part here, which is the discursive. It says, briefly discuss your findings in each section of A previously and advise whether the investment proposal is financially acceptable. So I just want to make sure that you know that how you need to present your discursive answers. So first of all, I would say that as per the previous calculation, NPV was positive. This means that the shareholders' wealth will rise. Therefore, we can accept the project. Therefore, we can accept the project, and that will secure 1 mark based on your comment here. The second one is on IRR. Now, my IRR was 18%, and when I compare that IRR to the discount rate of 10%, it was higher than the discount rate. So what I would say then is leave a line. Say IRR computed was more than the discount rate for VIP Co. This means that the project can be accepted as it is generating a positive NPV right now. And it is only up to the point that if it goes to 18%, only then the NPV would be nil. So up to 18%, it's a positive NPV. Therefore, we can accept this project. So you leave a line, and then you'll start talking about the ROC and so on. So these are some of the comments that this is the way you should do the comments in the exam based on your numbers. So again, on the numbers bit, please be very, very careful with your spreadsheet workings and ensure that your NPV and IRR is computed accurately, and the fact that you did not have to waste a lot of time in terms of using the discount factors, etc. And you can use the NPV functions in the exam quite easily. So I hope this was useful. If you have got any questions that you would like to ask on this NPV or the IRR, please feel free to drop me an email, and I will be very happy to help. And I wish you all the best for your exam on FM. And I hope that you really, really do well on your constructed response questions. Thank you very much.